To Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions. We're kind of in this make or break scenario. We've talked about that for the past couple of weeks. If you follow my videos and blog on the YouTube channel or on the Tradespoon site, so very important discussion. I'm glad you guys are here. We have a lot of people. So I'm gonna try to answer any questions you might have. So I encourage you to type in question. You can ask me about the weather. You can ask me about anything. I'll try to answer. Some of them I have some knowledge, some of them I don't, but I will answer to the best of my abilities. For those of you who are new, welcome, Paris from Chicago. I'm from Chicago too, so that's great. This is my brief bio as Executive Vice President, Head of Technology at Options Express. From 1999, again, another Chicago company, Options Express, was acquired by Charles Schwab. 2011, I was their first employee, very proud of that experience. Since I left Options Express, I started Tradespoon in 2012, right? If you saw some of my videos, I had some, trade in 2008, trade 2010, made few mistakes selling, naked calls against the position, lost a lot of money, and that was, and built a lot of technology to help me manage my own money, right? And went through some of the coaching programs with Dr. Maneker, and decided to take all of my experience and both positive and negative, and share it with, Tradespoon community, and that was the reason for me building the technology and Tradespoon in 2012. So I'm excited. I'm coming from family of teachers. I love teaching. I love building technology, and trading is definitely my passion. Disclosures: trading stock involves risk. It's not suitable for everyone. I encourage you to read optionsclearing.com for characteristics and risks of standardized options trading. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, it should not be assumed that the future trade picks will be profitable or will equal past performance. And you can see the relationship between Tradespoon and Trading Block on the bottom of the screen. All right. Before we get into rules, right, let's talk about current market condition, right? So market has been extremely oversold, right? We talked about spiders. We do have definitely start of the bottoming process, right? This is a great kind of a classical bottoming process where we have a double bottom, right? We had a double bottom, 380. The second one was lower than the 380, right? It usually depends on the news. I think one of the main reasons we undershoot 380 was because of the CPI data, right? CPI data was worse than expected. Market sold off. That got more hawkish. Was 75 basis points interest rates, and then we have news that also the same issues in Europe, and Bank of Sweden raising by 50 basis points. So news can definitely, when you have these double, triple bottoms, when you're trying to decide whether it's going to be lower or higher, it's definitely driven by news, right? If news are new news or they're worse than expected, then market is definitely oversold. Another, I'm going back to my notes. Another thing is just, again, try not to call the bottom. If you think that the bottom is 380, this is a great level to put your stop losses, but always assume that the market can overshoot to the downside, right? Because market was extremely oversold at 380, right? We were talking about weekly chart. We're talking about the weekly chart, and 380 is kind of a line in the sand, right? 62% retracement from the pandemic low to pandemic high, right? In the past 2 years, key level, everybody's watching 380 level. A lot of wealth management research companies publishing that 380 is the end of the year price target. So it's a pretty well defined level, and but that doesn't mean it's going to hold, right? It doesn't mean that just because everybody talks about it and you look at the technical analysis, that doesn't mean it's going to hold. So how can you prepare for that, right? in retrospect? How can you prepare for that, for these moves? You have to use position size, right? The only way to deal with the overshooting when the pendulum swings left and right to the extreme is, in retrospect, is to decrease the position size, or to use dollar cost average and maybe put only half of the trade on, right? If you think, we were putting on trades at 400, if you think that 380 is a stop loss, maybe you put half of the order at 400, and then once it does drop to 365, 370, you put the second half. This way, your stop level will not get triggered. Otherwise, you do have to follow your trading plan, and if you lost 2.5% of your position at 380, obviously at 360 you're losing 5% or 4% of your position. So then you're breaking your rules, and only to see that when you exited at 364 or 370, the market reverses. How many of you closed a lot of your position at 365 and 370? Does anybody close position, long position 365 or 370? Bill, Don, Mark, Mac, thank you. Anyone? No, everybody held on to them? How many did not close their position, long positions? All right, nobody. Okay. So, ideally, so some of you said yes, some of you said no, right? Some of you said it was painful, right? Some of you said painful. We were talking about fight or flight and flight response, right? The fight or flight response is an automatic physiological reaction, right? This is not something that you just don't feel good, or, you actually have, blood pressure going up and adrenaline levels going up, and can't sleep at night. So there are physiological changes to an event that is perceived as stressful or frightening, right? You thought that the market will bottom at 380 and it bottom at 365. A bottom, right? We're not talking about the bottom. The perception of threat activities, the sympathetic nervous system, and triggers an acute stress response that prepares body to fight or flee, right? Fight or flee, right? Some of you said it's painful, but you fight through it. Some of you said, well, it was too painful, and I kind of, close the position, right? It happens to everybody. The good news, you guys here in the live trading room, we're a community, we're trading together, we're here to support each other, right? We're not here to judge each other, we're here to support and provide, and share experiences, right? This is the purpose of Tradespoon, right? Share experiences. Some of us traded 20 years, some of us traded, 2 days, but we're here for experience sharing and not judging anyone. The good news, we're sharing these experiences. Everybody is experiencing these physiological changes. My number one goal is, how do I not experience these, physiological changes? If you traded 20 years, does it mean you get less, nervous when the market goes down? No, just, it doesn't matter how many years you've been trading. You have certain trigger points that is causing you to get nervous and get to this fight or flight mechanism. So the only way to fight or deal with this fight or flight mechanism is, again, boils down very simple, right? I think last month somebody asked me, like, what are some of the things you learn, in the past 20 years in terms of trading, right? Number one is positions, number of positions, right? Very simple concept, number of positions. Right, market rallies, right? Small caps are up 2.5%, Bitcoin is up 2.5%, gold miners are up 2%, railroads are up 3%, oil, metals and miners are up 5%, oil is up 3%. So I want to buy everything, right? I want to buy all of this because it's going higher and I feel fear of missing out, right? And I'm just buying more and more and more, right? And then only to see, we have something like this, maybe another day, and then some bad news happens and you have a sharp pullback, right? So since you don't know when you're going to have a sharp pullback, maybe it's going to be end of July, maybe it's going to be when earnings season starts, maybe it's going to be when the next CPI data comes out. Since you don't know, right, when you're faced with this uncertainty, the best way is to concentrate on things that you have control over, right? I don't have a control over when, you know, Swiss bank announcing, you know, 75 basis points interest rate hike, right? I don't know when it's going to happen. I don't have connection to these people. So, but I do have connections to number of positions, right? I can control number of positions. I propose on average 4 positions. Yes, I want to buy Bitcoin gold miners and I want to buy energy, but now you realize in a bear market, right? In the market where there's a pattern of lower highs, right? As long as we are in a bear market, everything is highly correlated, right? People were hiding, everybody was hiding in energy names, right? You turn on the news, you know, buy stocks that are, you know, low PE and high dividends and energy names and, you know, consumer staple names, and everybody keeps saying this as long as these stocks don't sell off. And then what happens next? Well, these stocks sell off just as much as, you know, banks, or just as much as technology, right? And it happens very quickly, right? Because they've been kind of the last man standing. So you have a 25-30% pullback in energy names, right? Drillers or MLPs. So the point is, in a bear market, there's no place to hide, right? Usually traditional places to hide is strong dollar. You can buy dollar, or you can buy treasuries, right? Those are the traditional asset classes that you can hide with. But you cannot hide in energy. You cannot buy consumer staples. You know, if you listen to the news and somebody says buy energy name because we have a high inflation and we have a war in Russia and Ukraine, and, you know, it's a traditional summer season and, you know, everybody is driving and flying, well, you know, but the trade is overcrowded, right? In the bear market, any overcrowded trade at some point comes to an end, right? Any negative news, right? Wednesday's supply numbers were higher than expected, right? Demand numbers, you know, lower than expected, and all of a sudden you have a 20% correction. So for that reason, no matter how much you wanted to buy more than 4 positions, I would encourage you to consider just 4, because in the next 6 to 12 months, I think this correlation will stay, right? When Germany is going to go up 2%, the United States was going to go up 3%, right? There will be some kind of multiple, but very rarely will you see Germany down and the United States is up, or Bitcoin is up and you know, technology is down. It can happen for a day, maybe it can happen for a week, maybe it can happen for 2 weeks, but eventually they will align each other, right? So for that reason, I encourage you to stick to 4 positions. I think this is an important rule. If you're a long-term investor, again, I'm in the camp that we're probably maybe in the second inning of the bear market. This is not a final innings, right? This is not a third inning. Best case scenario, it's end of second, maybe beginning of the third, right? Or maybe just, you know, end of the first inning, beginning of the second, right? Nobody knows exactly. So for that reason, long-term investment doesn't make sense. I don't think it makes sense to have 8 to 10 positions right now. I think you can get, for long-term investing, if your time horizon is 2 to 3 years, I think you will get a better entry point, right? Better entry point. If you don't agree, you know, fine, then just use dollar cost average. Still stick to 4 positions, but maybe break these positions to half, right? Or even if you have 6 or 8 positions, still only consider putting half of the size of that position in case, you know, market pulls back another, I don't know, 10, 20%, then at least you will lower your cost basis, right? And it'll take you less time to break even. So this rule is extremely important. I encourage you not to break it, right? We were talking about Ulysses contract, right? You need to have a contract. Right, you can read a story about Ulysses and sirens, right? You can, you know, my ex-boss always says, if you want somebody to pay attention to you, you send them FedEx envelope, right? You don't send email, people don't read email. You don't tell somebody verbally, oh, okay, you should meet me tomorrow at 5 o'clock, or, you know, you're late on your payment, right? You put a FedEx envelope and you send it to somebody, right? It makes significant impression on your brain, right? You have a lot more neurons firing in your brain, right? Than just an email. So trading is the same thing. You have to have a contract. How do you write a contract with yourself? It's not a mental stop, right? Mental stop is short-term memory, right? Going back to physiological changes, you want to commit your decisions to a long-term memory. How do you commit your decisions to long-term memory? You write a journal, right? You journal, right? And you write things down. It's not on a computer, right? You write it down, and maybe your business plan, right? Your trading plan should be in a FedEx envelope addressed to yourself, and you should maybe open it every day or every week and just read those rules and not break them, right? We all want to be, all of our goal, including myself, is to become a disciplined trader, right? My number one goal is to be a disciplined trader. My second goal is avoid fight and flight, right? I want to sleep at night. I'm getting older. I want to avoid these physiological changes, and obviously I'm here to make money. Right. Why did I put make money on the last item? Because when I was young, make money was the first thing. I kind of wanted to be disciplined. I kind of want to avoid fade and fly, but I really didn't do much about it. Right. As I get older, I realized, well, you can't make money if you're not a disciplined trader and you are constantly in this fight or flight mode. Right. You're constantly kind of living on the edge. And unfortunately, when market pulls back 30% in energy and everybody is in energy names, I have a lot of friends where I told them, don't buy, stay diversified. Don't put all of your, out of 4 positions, have all 4 positions in energy name. At some point, yes, you're making money, but at some point, you're going to lose everything you made and probably more. And guess what? Unfortunately, I was right? So they're not trading energy names anymore. So you don't want to be living on the edge or trading gas, right? I have my friend that always trades a gas. He says, I figure out gas. I know exactly how, natural gas behaves. I'm like, great, but at some point you will not figure it out. You'll make a mistake, and then you don't want to have this concentration in one position, right? So number of positions is number one rule, kind of I learned, right? Second one is position size, right? Position size is extremely important. If you have 4 positions, right, and they're, I propose 2.5% of account value. Right? When you decide how many shares or contracts to buy, you look at the worst case scenario, right? You always go through your positive. It's very important to go through positive and negative scenario. Even though, especially when you start trading, right, you usually don't go through negative scenario, right? When I start trading, I'm buying, I think it's going to go to 420, right? I don't think about where it's going to go. What if it doesn't go to 420? What if it goes to 350? I don't think about 350 because by nature, we want to avoid, from psychology, we want to avoid our negative thoughts. But, to become a disciplined trader and avoiding this fight or flight, all it means is in your journal, you have to go through a positive scenario. You can say, I have an opinion that, next level we can reach is, let's say, okay, February low, right? You can say, we're going to make new lows, right? If you're a bear, you're probably going to say, we'll make new low, but we're not going to break this, when the war, Russian-Ukraine war started, and we're not going to break 404, right? It's extremely strong overhead resistance that spans over multiple years, actually. If you look in the past 2 to 3 years, 404 has been kind of this war zone, right? War zone between bulls and bears for many years, actually. So you can, if you're a bear, you basically say, I'm not gonna, at 408, 405, I'm gonna, you're picturing something like this, right? I'm gonna, close my positions, right? Which is fine, right? If you're a bear, it's fine. If you're a bull, you're probably gonna say, well, it's gonna, we're gonna retrace to at least 440, right? If you're a bull, right? We're all biased, right? Always remember there's self-serving bias, right? If you're a bull, you're going to say it's going to go to 440. If you're bear, you're probably going to say it's going to go to 410, right? So remember, we all have serving bias, even though there's only one market, right? There's no two markets, but we're painting different pictures, kind of convincing ourselves what's going to happen next. But you need to think about where's the bottom to determine 2.5% account value. At this point, we spent day 1, day 2, day 3, day 4. Assuming there is no reversal, and we're actually going to finish this first week on a positive note, right, where we kind of break out, right? Very similar price pattern that we had here, right? We reached 380, day 1, day 2, day 3, day 4, right? Almost identical pattern. Day 1, day 2, day 3, day 4 breakout. So we'll see if this is going to be similar to the last two rallies, right? Last two rallies, it kind of topped out, right? 10% rally, 10% rally. This one was fast 10%. This is slow. So maybe again 10% rally. 360, 10% would be around 400. Around 400. If these rallies are similar to the last one. If they have more leg room, if there's positive news, like maybe next Friday PCE data is better than expected, then it'll be 15% rally, right? So it depends on some of the news. But right now, patience is important. 2 to 3 days to change the trend. 2 to 3 days. I would say now the trend has changed. So if we look at the model. Spiders is still negative trend. It's smaller than it was yesterday, but still negative trend. Model doesn't see the breakout of 386 on spiders because spiders is a day behind technology. We see a rotation where people are dropping their energy names and their consumer staples, and they're rotating technology. Technology model already adjusted, right? It takes very important notes. Right. Please keep in mind that, first of all, our AI models cannot predict macroeconomic events like CPI data is worse than expected. Right. A lot of people send the complaints. Vlad, model said bullish, but the market went down. Why is the model so wrong? I'm like, well, the model only predicts data movements. It cannot predict CPI data or the Fed reaction to the CPI data. If you think you can find a model that can predict what the CPI data will be and what the reaction of the Fed will be, then show it to me. I wanted to use it also. So, and it's a very important point. There's still a lot of subscribers think that there is a model out there that's a crystal ball that will always tell them, when light is green, you buy, and when light is red, you sell. Unfortunately, as you're going to learn and as you trade, that model doesn't exist. It doesn't exist at Tradespoon. It doesn't exist anywhere, right? There is an element of uncertainty and there's an element of chaos, right? Going back to the chaos theory in market. Market doesn't always move in periodic movement. Models is great to identify when market moves in some kind of periodic movements. And 90% of the time it actually does. 90% of the time market moves in some kind of patterns that the model can identify. But that 5 or 10%, it doesn't know, right? CPI data wasn't expected, right? It was being one example. And it will take, a second more important point, it will take on average 2 to 3 days for the model kind of to learn, right? Model learns. It runs every day at 6 p.m. or 8 p.m. It runs at 8 p.m. Central, and it learns on new patterns, right? So technology had already adjusted, and it's been showing positive trend actually, in the past 2 days, which is great, right? So, I mean, you have to kind of reconcile, why is spiders down and technology is up, right? That seems very unreasonable. But the main point is that, spiders had a weak rebound last Friday and closed slightly negative, but technology last Friday already had a green candlestick and post higher high, right? To the human eye, you might miss this nuance, but to the model, it actually was able to detect it, right? So That is extremely important point. So how do you determine? So 2 to 3 days, right? So now it's a positive day. So the bottom is set. So to determine 2.5% of account value, I propose to use this low, right? What is it? 268 on if you buy in technology, right? And if you buy in spiders, if you buy in spiders 362, that is your stop level, right? You can say, okay, it makes sense. I was patient. I waited 2 to 3 days. Market rally, right? There are two types of traders right now. So half of the people think that this recession is 30%, right, maximum, even if it's a recession, right? Nobody knows if we are in recession or not, first of all. But even if we are in the recession, average recession 30%, we're already down 25% on spiders. There's maybe another 5%, so they're all in, or not all in, but whatever, 75% of cash all in. Totally fine, right? Nobody knows. Are we in recession or are we not recession? There's a scenario where this could be the bottom, right? I can describe the scenario that this could be the bottom, right? Low unemployment, double-digit growth in S&P 500 stocks in July. Energy is down, lumber is down, aluminum is down. Demand is very high, and the rally can start, right? Positive GDP, and we took the liquidity out of the system, and market rallies, right? That's the bull argument, right? That's how the bulls think right now, which is fine. You're right. You have to figure out which camp you're going to belong. Are you going to belong camp bulls, camp bears, or camp I don't know? I'm going to follow Tradespoon. So all three camps are fine. There's no wrong and right, but the rules are the same for bulls and bears, right? The rules are the same. 4 positions, position size 2.5% of account value. How do you calculate 2.5% account value? You have to go through a negative scenario and basically say, listen, fine, 360 is 2 is the bottom. You can, most bulls think that 350 is the bottom, right? 350, this is 50% retracement from the previous pandemic low to pandemic high. You basically say 2.5%. If I buy now, you can basically say, if you're aggressive, you will say, well, 360 is my stop loss, or you can say 350 stop loss. I encourage you to say 350 is your stop loss, right? Because if we're going to drop below 350, then most bulls will become bears, right? If we drop 50%. So this is important stop loss. So if you're buying at 386, and let's say you're exiting at 346, right? Minus 30 points, roughly minus 30 points to do math, right? So that's your stop loss. So that's the thought process for every single trade. I encourage you to keep a journal, document all your trades in your journal, and you basically grade yourself, right? You basically put down A and B. If you follow your trading plan, you have to put a grade. Or C and D, right? C and D if you did not follow your trading plan. What do you mean? To me, every time you have a fight or flight response, you should grade C or D, right? You did something incorrectly, right? There is no reason to lose sleep at night, or because you know what your triggers are by this time, right? If you traded in this bear market, and a lot of you are still in this broadcast, then you know what the trigger is. For me, trigger is 4 times 2.5 is 10%, right? Portfolio drawdown is 10%, right? I have a large account, larger than average, right? Average account is $10,000. I have larger than average account. So for me, if I see my account down more than 10%, I start, I have physiological changes. So I want to avoid that. The way I do it, 4 positions, and then I break my positions to sometimes 50, sometimes 30 base, 30% at a time. And I wait for the market to stabilize to find my support, right? So that's very important. Minus 30 points on a $10,000 account, right? $10,000 account, it's about $250, right? So $10,000 account, that's an average account for you guys. based on our survey. So that means on every trade, I don't want to risk more than $250. So I don't want to risk more than $250. So 30 shares, that means, okay, then I can buy 30 points, so it's roughly 10 shares, right? Or 8 shares, right? That's 8 shares. So I can buy 8 shares times 30, that's $240. So do I buy all 8 here because I think it's going to go to 410? Well, that becomes your personality, right? I'm a little bit more conservative. I learned on my mistakes. So if I would have been buying, I would buy 4 shares. I would buy 4 shares here because I think it's reasonable to assume we can get to 410. Best case scenario 420. And it's another 30 points, right? So another 30 points. I have 30 points to the downside, 30 points to the upside. Bulls are in control. Okay, so I'm gonna buy 4 shares, but next week maybe the PCE data again is going to be worse than expected, and we might revisit this level. So if that's the case, I want to buy 4 more shares here, right? Because it's reasonable to assume that if PCE is worse than expected, we will have a pullback, but probably it's already expected, based on CPI and PPI data. So we're probably not going to break this level. So that's my thought process. So position size, a number of positions are the most important things, right? If I have to remember, right? There's a lot of things I covered today. If I have to remember, is you need a contract, right? You need to take this seriously, right? If you want to be a disciplined trader, you have to commit it to memory. Mental stops maybe will work for you. If you've been trading 10 years, I guess that works. If you've been trading 2 months, mental stops do not work. And again, I don't want to say not for average person, for average trader. For average trader, mental stops don't work. Your trade becomes your investment, right? We hear this on the news all the time. You start with the trade and all of a sudden is investment. Well, the problem is that if you did 4 trades and they become investments, well, then that's it. You have to wait till market resumes bullish momentum, which could be 18 months from now. So then for 18 months, you just sit and wait, right? You just kind of observe the market. So that's a problem, converting trades into investments in the bear market. So remember position, number of position size, 2.5%. Commit stuff to memory, right? Physical memory by keeping a journal. Very important to keep a journal. Very important to go through positive and negative scenario. Most beginning traders don't go through the negative scenario. Why? Just because we're humans, we don't want to think about pain or unpleasant experiences, right? So we don't think about that the market can reach 350, right? Usually when you buy at 380, you only think about that it's going to 420. You don't really care where it's going on the downside. You're only going to start caring when the market started reversing. And we can see last reversal, it was literally 3 days. 3 days and 10% of the market is gone, which is, and unfortunately, this is how the market is going to stay for the next 6 to 12 months, right? Any bad news, CPI data worse than expected in 3 days. If, companies going to start pre-announcing that we have a strong dollar and they're losing money, right? Like Microsoft or like CRM already did, or Walmart, blaming the supply chain issues. Well, again, 3 days and all of a sudden market is down 10%. So reacting to these news is very difficult, but determining position size is very easy, right? It's very easy. You just pull between fear of missing out or fear of future regret. All right, any questions? I know I covered a lot. I want to make sure that Mark, the profits recently. Mark from Rogers Park, or is this different Mark? Mark, where are you from? Yes, Supreme Court overturned Roe versus Wade. But, Unfortunately, at least for now, no effect on the market. Okay. For Bosch, right? A lot of companies. Thank you, Kevin. What percent, Bill? What percent of stop loss on options do you use? On options trading, longer term trading, usually 50% stop loss. But again, the main rule is 2.5% of account value. No matter what happens, I don't care if you trade in options, futures, Bitcoin, Forex, derivative and a derivative, triple derivatives, it doesn't matter, right? What matters is 2% of account value. The reason I like to use account value and not percentage of the stop loss for very simple reason, because some people like me who's very conservative trades QQQ and spiders. Somebody who is a lot more aggressive, they're trading ARK or Bitcoin. But Bitcoin is going to move a lot faster than technology, right? Bitcoin is down 80%, where technology is down 35%, right? But they're moving in high correlation to each other. So if you trade in Bitcoin, it's the same rule. It's 2.5% account value. If you trade in options on the option, or future option on the future, it's the same thing. 2.5% of account value. You have $10,000 account. Figure out where your stop level is. I encourage you to look at the spiders. This is your stop level. It reaches the stop level, you exit out. Carmen, yes, everything gets recorded. Deborah had a question about what do I think about energy names. At this point, I think energy, Bitcoin, technology, they're all going to behave the same. I think people who are still saying that this is a healthy pullback in energy and it's a summer season and people travel, and I met my wife in the airplane. I mean, she traveled from France. I mean, I've never seen lines in the airport like this. I mean, it's like out of the end of the world movies, right? Just like, I mean, it's just insane. But market looks forward, right? Market doesn't look backward, right? Market knows that people are traveling a lot, but why is it trading at pre Russian-Ukraine conflict, where Russian-Ukraine conflict, if anything, it's escalating. It's not getting less, right? And but market looks forward, right? And the reason market is down 30%, most likely the only explanation, and is the same explanation why 10-year yield in an inflation all of a sudden dropped from 3.5% to 3%. The answer is market already looks forward. Looking at this data, one interpretation that I follow, it's one of the interpretations, it's not the interpretation, but one of the interpretation is that we shouldn't be concerned about inflation. Probably inflation is reaching its top, right? It's probably we're going to start seeing inflation subsiding, right? CPI data months over months, year over year will start dropping. It might be in July, might be in August, might be in September, don't know when. But the market already anticipates this. But the reason we're still down, energy is down 30% because market anticipates that the demand will decrease substantially, right? For traveling, for building houses, for getting mortgages, that the damage being done, this is not a soft landing, this is a hard landing, right? Hard landing. That's the term everybody's used, hard landing, or meaning that either this year or next year we will have a recession, and market looks forward to that, right? So that's an explanation. So if you follow that explanation that we are not in a soft landing, then XOP energy names are, at least now they're actually underperformed, but still think it's way overdone. We're talking about ABC pattern. It's reasonable to assume that at least 50% retracement. This is now again overhead resistance and leg lower. So same, my opinion on the energy is the same as an opinion on technology. It's the same opinion on Bitcoin, on consumer staples, or any other product you can think of, right? Except treasury is different, gold is different, currency is different. Not different, but still highly correlated to equity market. We will have rally. We're going to have violent rally, right? 30% down. 124 to 144, that's 20% rally. So you can have up to 20% rally. I think it totally makes sense. I would wait for some stabilization, right? We're at the pre-war, right? Pre-war high. So rally into July 15th. I think after earnings, after Apple, JP Morgan announcing earnings, I think there'll be a lot of negative news, right? Expectation is low double digits, high single digit. I think if we're going to have lower single digit growth, or some companies will have negative, then that's the next leg down. I could be wrong, right? It could be not end of July, maybe it's end of August when all the companies will announce, right? Because there will be a hope that the next company will shed a better light. But once the earnings season is over, end of August, early September, people are going to say, well, what's next? We still have high inflation, maybe not as high as in July, but still, record level of inflation. Mortgage rates are still high, and all the bear argument. I don't have to relist all the bear argument, and then market rally. So that's my view on the energy, and hopefully that makes sense. Carmen, since we're in inflation, what are the good inflation proof? I think we're in inflation, but we're also heading into recession, right? So the only thing, good assets, kind of long-term, I'm personally moving more and more toward treasury and dollar. So traditionally, if you think we are in the hard landing, dollar and treasury. If you think we're in soft landing, then you can, then the narrative stays the same, right? Buy commodities, buy high investment stocks, buy Disney, buy, JP Morgan, buy, I mean, right? You have soft landing and hard landing. So if you say soft landing, right? If you're long term and you can't, you're not an aggressive trader, TLT, usually people hide in TLT, usually people safe haven, DXY. Those are the only two places. Even gold, you look in 2008, it sold off. So this is long term. This is sorry, this is hard landing. Scratch this. Sorry. Hard landing. And if you're in a soft landing, right? If you're in a soft landing, well, then market is extremely oversold. You can buy, XLP, but where people were hiding mostly is XLP and XOP, right? Consumer staples and oil drillers, right? XL, consumer, your Coke, Procter & Gamble, Ultra, right? Walmart, Costco, Dollar General, and XOP. So first you have to decide which camp you are. Are you in the hard landing or soft? Because soft landing, then we are close to the bottom. Right? I mean, maybe another 5–10%, but we're close. It makes sense to buy. If you think we're in hard landing, well, the bottom is probably somewhere in here, right? So we're like halfway to the bottom. So you have to kind of have an opinion about hard landing, soft landing, which is not a very well-defined task, right? I think we're in hard landing. We can end up in soft landing, right? And if you think we're in soft landing, we can end up in hard landing. So unfortunately, you kind of have to decide which scenario is going to play out to invest. Any other questions? Carmen, I don't have again hard land. If in hard landing, all the commodities will sell off. Long TLT, yeah, long TLT would be my choice. Every quarter, so the question, Carmen had a question, rebalancing hedge funds or institutions. Every quarterly rebalances you have, right? We have, where is the next quarter? I'm drawing down January, February, March, April, May, June. End of June, right? So end of June, we're gonna have rebalancing, right? So a lot of institutions you know, they're gonna, most institutions, right, UBS, Fidelity Investment, Vanguard, everybody was talking about soft landing, right, for the first 6 months. They don't move every day, right? These guys are, so now end of June is gonna come in. People already getting their statements, you know, from their 401k, which doesn't look good, right? Down 25%, that doesn't look good. You know, most of them were in a soft landing, right? A lot of them are now shifting into a hard landing, right? So end of June, there'll be a rebalancing, right? End of the quarter, am I right? So, April, May, June, right? End of the June, there'll be rebalancing, right? Triple witch Friday expiration, and all this, you know, great stuff is going to happen. So more volatility, right? More volatility, right? So depending which side is going to win, it can cause market to continue rally short term, or it can start that sell-off end of June, right? That's also possible, which is, you know, next week. Bill, prolonged denied recession. I don't know how far this thing goes. That is not my, I mean, I've read some research that does compare how far this guy. So the question is, how long can this recession or bear market last, right? Well, first of all, this is right. So the idea is, you know, if you invested in March of 2000, right, only in February of 2016, 16 years later, would you break even, right? So a lot of basically people say, well, if I start trading in, you know, if I start trading in, you know, January of 22, you know, when am I going to get positive, right? And a lot of people say, well, next 16 years, right? Not a lot, but there's some research out there. And the other one is inflation, right? 1965 or 1970. When did this, right? If you start investing in 1968, you know, 1992, 20 years, you start making money, right? Because of the, you know, prolonged recession of 70s and 80s, right? So if you start investing in 1967, you probably never invested again, or, you know, it took you 20 years. So it could be 70s and 80s, right? Because this is also hyperinflation Walker rule. There's some research that tries to ascertain that, you know, if you start investing in 21, you know, next time you're gonna make money will be in, you know, 31. Nobody said 20 years, but I've seen 31. There's no signs of that, right? I mean, that's pure speculation, right? Even if we are in a short-term recession, you know, 2-3 quarters of negative GDP, we still have, you know, very strong economy completely different from 1960s or, you know, 2000. But it's possible, right? But also, you know, remember that, you know, even if you invested in 240 or you invest in 260, even if 360 is the top for the next 5 years or 10 years, I don't know what it is, you know, it's still significant rallies, right? All these markets, you know, they had a sharp pullback, they had sharp rallies, right, of 20-30%, right? Same thing was in here, right? I mean, you had a sharp pullback, but you had a sharp rally, pullback, sharp rally. So that's where dollar cost average is important, right? You don't want to invest all of your money, you know, in when the, you know, high-tech companies, you know, didn't have any cash flow, right? This is different. Majority of these technology companies, they were selling water, you know, to the people, right? They were selling nothing, right? They didn't have any assets. Right now, I mean, we have some of it like in Bitcoin, but, you know, Google and Microsoft are still making money, and most of these companies, and, you know, all of the, you know, high beta stocks that already got flushed out. So I don't think this is similar to September 2000. I don't think this is similar to 1970, but time will tell. Good question. Thank you, Bill. Hard landing and soft landing. Hard landing is that Fed will fail by raising interest rates aggressively. It will tilt the economy into recession. So, and the acronym for that is hard landing. Soft landing is that Fed is going to be successful, and it will, instead of plain crashing, it will have a soft landing, right? The economy, it will not destroy, unemployment. We're not going to have, 8% unemployment or 10% unemployment, and we're not going to have recession. So soft landing versus hard landing. I think this is a trade. Yes, so this is a trader's market, and until we see signs otherwise, this is a purely trader's market. Trader's market means that you don't want to convert your trades into investment, right? You have clearly defined stop levels, and when your stop level triggers, you exit position. That would be the definition. All right, it's 10:25. Any other questions? So how do we help a Tradespoon? I have experience, first of all, don't trade alone, right? This is a market, obviously, that most of us haven't traded in, right? We've been trading 6 months, lower highs, lower lows. Last time it happened is in 2008. Most of us did not trade in 2008. So just by that thought process, I encourage you not to trade alone. How do you not trade alone? You join our elite service, and there's we have a great community. We have a lot of questions you've seen here. We're asking a lot of good questions, a lot of good ideas. So the number one rule, or my suggestion, do not trade alone, right? Be part of some kind of community, some kind of a live trading room where somebody can show you, pros and cons of being a soft landing and bear landing, and give you a choice where you want to decide to stay, right? So we have a morning bell and closing bell every day where you can participate live. We show you all of the recordings of all of these sessions. And the most important, trader log, right? Today, I start trimming QQQ position, right? I've been trading around QQQ. You can look at last 30 days. What did I do with QQQ? And you can see, okay, I bought, rolled the put, 280, 260 put, close 260 put, rolled it to 240 put. I bought at 285, now I'm trimming at 292. I trimmed at 310. So you can see all of my positions and all of my trades, right? And at least if I'm closing QQQ, if I close it completely, then you know that I'm probably bearish right now. If you see I close it by a still position in QQQ, well, I'm probably still bullish. So you have a real-time communication within seconds where you get your SMS message, you know exactly what my positions are, you know exactly what my orders are, and every single trade accompanied by a video where I go into details explaining, why I did and what I did. So I encourage you to try this service. Obviously, it requires investment of your time and money. If you don't have time or money to invest, then search for Tradespoon. And subscribe to Search's channel. This doesn't require a lot of time. That doesn't require any financial resources. This is just, before you go to sleep and you want to get a good night's sleep and you like my voice, then every day I'm posting a video on what I think the market is doing, where the support, resistance, soft landing, hard landing, bearish short-term, bullish long-term, and if you do like the videos, I encourage you, do me a favor, but something for me. If you like any of these contents, if they're helpful, and you first of all like them, I do like likes, so like the video and share it with anyone you know who's trading. If you're part of the traders community, if you're part of some forums, traders forums on Discord, YouTube, Facebook, Instagram, I don't know, then post links to these videos. I would greatly appreciate. We're trying to grow our community. my goal is to get to 1,000 this year. So any help, the more you like the videos, the more you share them, the easier for me to get to 1,000. So if you like the content, I mean, obviously you need to like the content, but if you do like the content, if it's helpful, it helps you trade, please share them. All right, any other questions? What happens in the recession and how do we invest? In the recession, market sells off, right? 2008, right? You can see, we have few recessions. 2020 was the last one by definition. 2 quarters where people were locked up. Question is what happens during a recession, right? So last recession, spiders pull back 35%, right? Average recession, I think, is around 35%, 35%. So average recession, but one of the shortest recession, right? 2 months and we're out. So that's 2020. The one before that is 2008, right? Lehman collapse. And Bear Stearns. Financial crisis, leveraged mortgage-backed securities. Again, a lot of paper. Sounds like Bitcoin, right? Even though my nephew would argue otherwise, but at least it resembles what's happening in Bitcoin right now. But in 2008, oh, am I doing days? Sorry. In 2008, the recession market was down 55% from top to bottom. So 55%. And you had systemic issues in the banking, right? So significant problems, right? Which we don't have right now, right? I mean, we have inflation, but I don't think it's unmanaged. I don't think it equates to the collapse of the banking system and banks not lending to each other. I think banks not lending to each other is a lot worse of a problem than inflation. So 55%, the market, it took, almost a year for the market to bottom, right? The recession, bear market lasted almost a year. The one before that was the, September 11 and the collapse of Iraq war, September 11, and technology. So 50% down, top to bottom, 50% down. Lasted 3 years, down market from 2000 to 2003 to reach the bottom. So prolonged, much longer recession, 3 years, and then we had, 96, 87, but the idea that they can last anywhere from 1 to 3 years. The bear market can last anywhere from 1 to 3 years. The market could be down 50, 60%. But they are always, the positive news, they're always followed by extreme prolonged bull market. So the positive news is now, at least for me, is that we're down 25%. If we're in a soft, I think we're in hard landing. But if we're down another, let's say 15%, right? Let's call it, I think it's reasonable to assume we can reach pre-pandemic high. That would be 32, 35%. That would be average recession. I mean, can it be down another 20%? Yes. But does it mean I can start buying long term? Probably yes. Same thing. 30%, you put, I don't know, 40% of your cash. If it drops to, 41%, then you put another 30% of your cash. And if it drops, pendulum swings to the extreme, midterm elections, who knows what's going to happen. If it drops 50%, that would be to 40, then you deploy all of it, right? You're not going to catch the bottom, right? Nobody can catch the bottom, but people know what the average recession is, how long it usually lasts, what are the signals of the bottoming process, right? The spikes in volatility. So when you start seeing VIX at 50, 60 and market down 35, 50% in that range, these are long-term opportunities, like a decade-long opportunities that can generate a lot of wealth in the long run, right? You just need to be patient and wait for it. All right. On that positive note, I want to say thank you very much. Please sign up for Elite Circle if you have time and you have financial resources. If not, please sign up for the YouTube and spread the word. Spread the word. I like likes. It makes me feel that what I'm doing makes a difference, and share it with your friends and family. Thank you very much and have a great day. Carmen, I bought a QQQ. I sold QQQ stock. I didn't sell to open QQQ, right? I closed it. This is sell to close. Right, sell to close. It's not sell to open, it's sell to close. I closed QQQ position. Partially. I still, if you look at the position, still have QQQ. Bill, thank you. Carmen, thank you. Bill, did I change my opinion on FCX? No, for now, no. I mean, it's been brutal. It's a lot worse than I expected, but at least for now, this level holds. We are up 2.5%. Metals and miners are up 5%. I mean, one day doesn't change the trend, but again, I don't think there'll be a lot of divergences between, it's not like technology gonna continue rally and metals and miners are gonna sell off. So either technology is gonna sell off and sell-off will resume, or metals and miners will follow the technology. I think it's the latter. I think we're on week 1. Looks like we're closing this week in a positive territory. I think there should be probably at least another 1 or 2 weeks of this up movement. I mean, we haven't had. I mean, last time we had 2 weeks of positive was in March. This was caused by the CPI data. Assuming there is no negative news, probably pattern like this, another 2 more weeks of higher highs, and maybe week 3 and week 4 will lose momentum. So that means FCX and QQQ will trade in the same fashion. Faust, thank you. Carmen, thank you. Trader, thank you. Carmen. Everybody, thank you very much and have a great day.